Hello, everybody. Welcome to our third quarter webinar behind the portfolio. My name is Dylan Martin. I am the new financial advisor here at Stewardship Investments. I'm a certified financial planner, and I'm excited to be on the team here with Matt and Joe to help continue providing excellent service and great advice to our clients here. Today, I will be our MC. I will be interviewing both our CIO, Chief Investment Officer, Greg Towner. Greg is a chartered financial analyst and a chartered market technician. All that being said, those are really great designations that just says Greg is a really smart guy, really knows what he's doing in the field of investments, and we rely pretty heavily on him in that area. So we're thankful to have him here on the team. We'll also be hearing from Matthew Myrick, one of our head financial advisors here at Stewardship. Matt is a partner in the firm, and he is also a certified financial planner. Matt also really knows his stuff, so we should be able to get some great information from both these guys today in the realm of portfolio construction and investing. So today we will be walking through three main points. So we will walk you guys through biblically responsible investing. So that is really the why behind our portfolio instruction. Also throughout the rest of this webinar, I will just be saying BRI, as after this webinar, I would love for you all to go try to say biblically responsible investing 5 times fast. It's challenging. So BRI here for the rest of the webinar. We will also take a peek behind the curtain, look at the nuts and bolts behind the portfolio, as the title indicates. So there we will really see the how. We'll see how our portfolios are built, just from a technical and a practical standpoint. So you'll get the why, you'll get the how, and then we'll really tie everything back together to see how our approach to investing and financial planning ties into how we invest for eternity, and how a biblical worldview influences our overall approach to financial planning. So to start our time here today, I'll stop sharing my screen so you guys can see us here. We will look to Matt to get the questions going. So Matt, what is BRI and why is that so important to us here at Stewardship?
Thanks, Dylan. Yeah, like Dylan just mentioned, BRI stands for biblically responsible investing. There are other terms and acronyms to suggest the same philosophy. Values-based investing is another one, and it means that we design our portfolios by purposefully screening companies by whether or not they would align with a biblical worldview. So and there's two components to it. One is an exclusionary side, things that we maybe want to avoid, and then there's also the side that we want to embrace. Right, there are good companies that we do want to own that we think have a very powerful impact. So an example of a company that we maybe wouldn't want to own, that we would want to exclude from the portfolio from the BRI perspective, might be a company that produces pornography. And on the other side, companies that treat their employees very well, that produce goods and services that lead to human flourishing. Those would be examples of companies that we would want to embrace. That'd be very attractive to us from that perspective.
That's great. So with that, Matt, just practically speaking, so we have BRI. So how in our portfolio, how are our investments actually making a positive impact on the world?
Yeah, great question. One time when I was in a classroom setting, somebody asked me what the difference was between gambling and investing in the stock market. And the answer is ownership, right? So sure, with gambling or investing in the market, right, you take risk, but when you own a stock, right, when you put capital into a company and you own it, you become an owner, and then you profit from what that company does. And in its purest form, right, you supply the capital to that business so that they can perform their functions. And we think there's tremendous merit in owning companies that a collection of companies, thousands of companies, that have a positive impact by very nature of what they do. So, maybe another way to think about it is in the spirit of supporting missionaries. You've heard people say, well, you're either a goer or a sender. I like to think of it like when you take ownership of biblically responsible companies, in a way, you're being a sender into the business world.
Yeah, and Matt, I know I wanted to just chime in and give one example of one company that we own in many portfolios. We own a healthcare company that's in the medical equipment field, and what they do, they follow the BRI and they make a specific medical device that allows surgeons to do an increasing number of surgeries very efficiently, but most importantly, very safely. So very much a positive impact on the individuals, on the industry, on the world. And so those are the types of companies that we're seeking out that can obviously be good for the investment side, but also well beyond that as well.
Yeah, absolutely. Thanks for speaking into that, Greg, as well, giving us a good example there. Matt, can you also give us an example of a fund that we own that you feel like does this well also?
Yeah, to piggyback off of Greg, Eventide Asset Management is one of our key partners, and they donate a portion of their profits to missions. And in addition to that, they also sponsor a lending fund to help small business startups in impoverished parts of the world. And so just partnering with companies that kind of have that shared vision for making a positive impact. Eventide is a flagship of that.
Amazing. Yeah, I know we greatly value our partnership with Eventide. They do a lot of great work. So turning over to you, Greg, more on the how of our portfolio and how it's constructed. Would you tell us a little bit more about your core and satellite approach to investing?
Yeah, absolutely. This is really a fundamental part of how we construct portfolios. So we look at owning a number, really the majority of a portfolio being in what we call core holdings. That could be anywhere from big blue chip individual stocks that have a long-term fundamental track record. It could be diversified funds, ETFs, that sort of thing. We want a good portion of each portfolio to be constructed with those that we have a longer term positive view on. Obviously, they'll have their ups and downs like anything, but we may look for some of those occasional weakness opportunities to add to them. And we supplement those core holdings with satellite positions, as we call them. Those are some that might have greater growth potential. Perhaps they're investing in certain cyclical areas, and we think their area is doing well in the economy right now. Perhaps certain thematic areas. We tend to not hold them as long potentially because of they are going through a specific period that we want to try to take advantage of. But when we look at core and satellite, we really think it blends the best of buy and hold, which I think most people have heard of, with active management. I mean, buy and hold is a great strategy, but the difficulty is a lot of people, they do the buy, but they have trouble with the hold part. The market flushes them out at the worst time, or then the active management part. Some people think that they focus on the word active and it's just, a lot of trading, and that's not how we go about it. So we're really finding a way to blend long-term core holdings, kind of a buy and hold approach, with a little bit more active approach that has unique opportunities while maintaining some risk management on them as well.
So Greg, dialing in on that maybe a little bit more specifically, can you also walk us through the process of how you actually evaluate and pick some of the funds and holdings that you choose in portfolios?
Yeah, absolutely. Well, of course, it starts off with the BRI screen to kind of, narrow down the field there. But then as you dig into it, specifically referring to looking at funds and ETFs, for example, I mean, obviously we look at what their past performance has been, but oftentimes we think people focus either too much on that or in the wrong manner. So what I'm getting at there is we tend to focus a little bit more on how they're doing against their peers, other managers managing in the same type of strategy or the same type of asset class. And the reason being is because if you just focus on how a fund is doing against, say, the broader market, for example, over a very long-term time period, that might be okay. But in any shorter period, their specific area could be much out of favor. So maybe their value manager and growth is doing well, or maybe their small cap and large cap is doing well. So we're focusing a little bit more on how they're doing versus their peers. As we drill down a little bit, we're certainly focusing on how the funds do in both up markets and down markets. So it's not just the total return. You want to look at, are they trying to keep up in the up markets, or are they more a defensive strategy that is trying to be more defensive and protect funds when market's going down? So that's important. Obviously, we'll look at expense ratio and turnover and some of those metrics as well. Those are all the quantitative type of things, but there's also a very important, more, let's call it qualitative aspect that we look at when evaluating as well. And that really comes down to, do we think that the manager of the strategy is performing a repeatable process? So what I mean by that is, if you look at, individual investors, for example, are often prone to just kind of chasing what's hot or what they saw on the news or what their friend told them or what have you. And honestly, professional managers are not completely immune from that. So we want to make sure that the professional manager is following a process that they've done over time. It doesn't mean they're always going to be right, of course, but we have confidence that they're going to be able to follow that process over time and not just go wherever their latest thing that they heard is. So that's an important aspect in our process for choosing managers.
So with the, so you have the expense ratios, you want great managers, repeatable processes. With all those different factors, Greg, what would you say is or are some of the most important criteria when you're evaluating those different investments?
Yeah, absolutely. And I'll kind of separate a little bit here between when I'm looking at individual stocks versus, say, funds. So for stocks, we're not going to get too deep into all the process with it, but let's just say that we focus a lot on quality. We want stocks to have passed certain quality metrics because we think that that will help them perform well in the longer term, particularly during difficult periods. And by quality, I mean basically that they're able to generate an increasing amount of cash flow from their business. So that would probably be, if I had to just focus on one thing for stocks, that would be it. Of course, there's many other things we look at as well. But back to funds, I would say that we really want to look at, what is the fund performing the way that we think it should, given the environment that it's in. So again, we want them to be a repeatable process. We want them to be performing the way that we think they should. In other words, if small caps are doing well and they're a small cap manager, well, we really prefer to see them doing well, right? But now if small cap's doing poorly, we're not exactly expecting them to be crushing it necessarily. So are they doing what they should be? Because if they're not, maybe they're kind of straying from what their designated process was supposed to have been.
Awesome. So we've got our core and satellite approaches. We're digging in, we're picking funds, we're picking investments. So kind of taking it a step further with the portfolios, Greg, how are you incorporating, we would say, maybe some both short-term goals and long-term growth strategies together in the portfolios?
Yeah, and this is really where we blend together, my team, the investment side, with the advisors, working with the clients and kind of meshing together the two into a really, what is the asset allocation that is needed for that client, maybe specific buckets for their assets. So for example, if they have a short-term goal, most, if not all of that money is going to be in some sort of money market type strategy to keep it safe and protected, but still earning an attractive return. If it's more intermediate in nature as far as time, whether that's 2 to 5, 2 to 10 years, something in that range, then you're going to be usually looking at some combination of fixed income, perhaps some stocks that maybe are a little bit more conservative, say dividend payers or something of that nature. But then, of course, if you're longer term money, that's where most people are looking to grow it to reach their longer term goals.
Yeah, great. Thanks, Greg. That's such a great analogy of the bucket approach that we talk about with clients on the planning side. We've got our our now bucket, which is money that we're going to be spending very soon, and that's no risk. And then we have our middle bucket for kind of a shorter term time frame. It's not a long term investment. We're going to use it soon, but we hopefully want to pace or beat inflation if we can. And then of course we have that longer term strategy, which is really where Dave Ramsey's mantra of long term investing and trying to take the breadth of the market rallies that we get, and that's going to be the more aggressive bucket for a longer time frame. And so that's a great summary.
Thanks for that, Matt. Yeah, it's helpful to see how the investments actually tie into the planning, that marriage there. So sort of changing the tune a little bit, Greg. So we've been talking about maybe how do you pick funds, and how are you choosing, what criteria are you using? So when do you decide to add or actually remove a fund? So what does that process look like?
Yeah, specifically focusing more on when to remove, because I think we've talked a lot about the things that we look for when we're looking to buy a fund. To some extent, it's just the opposite when we're looking to remove. In other words, when we're doing a review, if they stopped meeting those qualifications. But more specifically, we really want to see, is a manager no longer following their process? And it's not always easy to look at this. Sometimes you got to dig down into the holdings, see how they're performing versus their peers. But again, we really, if we're hiring a manager or purchasing a certain fund, we're doing it for a specific reason. And if they start to stray from that, in other words, let's just say we're hiring them as a mid-cap value manager, and we look and they're owning a bunch of large cap growth because that's what's doing well. Well, maybe it helped their performance, but it doesn't give us a lot of confidence that they're going to follow what they say they're going to do in the future. So we want a manager that's following the process. If we're going to remove a fund, there's also a pretty good chance that they've had a repeated underperformance in numbers versus their peers. Again, we're focusing not exclusively, but a lot versus their peers, because that's who we have to choose from. The time frame for that is difficult. I know a lot of people focus on the short term. It's really difficult to do that. There's a lot of noise in the short term. So really, you're wanting a number of years ideally, but if it's not meeting the other qualifications, you can look at shorter term as well. And then sometimes there's just better opportunities. We've switched out of investments before that we weren't necessarily having a problem with, but you only have so many slots to put into the portfolio. So sometimes you just have to kind of push something aside when you have a better opportunity, whether that's because something's changing in the marketplace or in the market as a whole, or just because something new has popped up on your radar.
So also outside of adding or removing funds, how else might you monitor and adjust the portfolio over time?
Yeah, no, that's a good question. So every quarter, every position that we own gets a new full review, both from a fundamental aspect and from a technical aspect. So we want to see, is the original criteria still being met? Has anything changed there? And there will occasionally be times intra-quarter, more so for individual stocks than funds, that will say, hey, something's popped up here. We need a new full review. But it's not just myself that's looking at that. My team is obviously doing that, but also very importantly, we utilize some really good third-party research that helps us not only evaluate the specific securities, but perhaps more importantly, evaluate the broader macro landscape that we're in as far as the economy and the broader market and everything going on in financial markets. And that helps us a little bit decide to what extent do we want to include, let's just say, for example, international versus US, or small cap versus large, or stocks versus fixed income, bonds, that sort of thing. So it's a combination of quarterly reviews for the positions and utilizing outside research to kind of build the portfolio that fits the environment that we're in at that time.
That's great, Greg. Thanks. Yeah, so we have those quarterly reviews, but then every once in a while we have quarters where like upcoming, we have big events coming up like the election.
Right.
So there's a lot of uncertainty and volatility that comes with the election. So what are some guiding principles that you would say investors should follow when facing that uncertainty that comes with political elections? And then maybe just paint a picture for us on how portfolios have reacted in the past to election cycles.
Yeah, absolutely. Well, kind of starting bigger picture with it, we'll just say simply, don't combine your political views and investing in any way. I mean, it's just been a bad combination over history. It's not only bad for your wallet, but it's bad for your mental state as well.
Mm,
One thing that a phrase that we use a lot is avoid the noise. And that's probably no more relevant than it is when it's tied to politics and investing. So we would encourage people to just not combine the two. But to the second part of your question there, to give a little more specifics about it, let me give a few things here. So let's just for starters, let's look at the last two presidential elections, right? 2016, a Republican won. In 2020, a Democrat won. In both cases, different parties, the market, what did it do? Almost immediately, not almost immediately after the election, it went like straight up, okay? May or may not have been about who was elected or not elected or what have you. But the bottom line is it happened. Well, what if we go back further in time? I mean, if you look at the last 18 presidential elections, so we're going back to the early 1950s now. In 16 out of those 18 calendar years, the year of the election, the market finished higher. The stock market finished higher, the S&P 500. Only 2 years in election years, the markets finished down. That was in year 2000, which was right after the dot-com bubble implosion. So there was a lot going on there beyond the election, of course. And then in 1960, when the market was just down fractionally, so it barely even registered. So all those presidential election years, different parties winning, lots of different types of people and beliefs winning. And yet the market was just like, okay, we're going to do what we're going to do, right? Maybe there's a little noise before, maybe there's a little noise after, but at the end of the day, not that big a deal. We've looked at a lot of studies. I thought about sharing some here today as far as all the data, but I think it was going to get to be too much numbers. But what I'll say is, if you look at any mix, in other words, let's just say, a Democrat president and a Republican Congress, or, Republican president and Democrat Congress, some sort of mix between, Senate, House, and president, stock market did very well when there was any kind of combination of a mixture. The one thing is we drill down into the data that we found that maybe the market is just a little bit less excited about is when one party, either one, it didn't matter, had all the power, had, both Senate, House, and president. So the market tends to prefer not to have all that power in one hand, regardless of the party. One caveat with that is, there's not that many examples of that. In a statistical manner, it's only so relevant that you can prove. But at the end of the day, to us, most important message is don't combine politics and investing. It's just going to get you to pull your hair out and potentially worse, make some sort of emotional mistake with your investing.
Thanks for that insight, Greg. And something that tends to go hand in hand with political uncertainty, excuse me, is the news. The news tends to maybe perpetuate that a little bit. So if I'm an investor, Greg, and I'm watching the news, and I come to you and I'm saying, why doesn't my portfolio match what's going on the stock market news? There's say there's an index that's reached an all-time high, and my portfolio doesn't exactly line up with that, and that can be frustrating at times. Why is that?
Yeah, no, that's a great question. I think there's a number of different potential reasons at any given time that can be the case. First, let me step back. We've looked at a lot of academic studies over the years that look at the actual returns that investors receive compared to the funds that they're in. So for example, if they were invested in an index fund, most of the time, or a majority of the time, investors don't actually receive the returns that they're seeing in those index. And the reason being is because they're going in and out, they're allowing emotions to drive their investing, and they're going in and out of it. And so they're not actually achieving those returns that they look back and say, oh, that's what the index did. And in fact, we just read another study here recently from Morningstar that verified that. So it's dangerous to look at the index and say, oh, I could have had that. So a lot of times people can't handle that volatility. And so for us, a lot of our investment process and portfolio construction revolves around trying to reduce some of the behavioral mistakes that investors can make over time. So we're trying to build portfolios that are of high quality nature, that can over time just have a little bit smoother type of return than broader markets, a little bit more risk management. The best type of portfolio for any investor is the one that you can stick with through good times and bad. It may or may not be what the market is doing at any given time, but if you can't stick with a certain investment, it doesn't matter what the end return would have been. if you aren't able to stick with it. So the behavior is important. Another way that we do that beyond the quality and the risk management is diversification. I know it's just one of the most simple, basic concepts out there, and some people shrug it off, but it is so incredibly important. But one aspect of it that a lot of investors forget is diversification means sometimes some of your investments are doing well, and maybe sometimes others are not doing as well, because if they're all doing the exact same thing at the same time, probably not as diversified as you thought they would be or you would hope they'd be. And then, honestly, if you're following the BRI like we've talked about, we don't own everything that's going to be in an index. So, for example, in the recent years, what's been driving the index a lot, I think most people are aware, is these huge, mega cap, mostly technology type companies that many of them don't follow BRI. And so your portfolio isn't going to look like that index. Now, over time, that may work as an advantage. There will be a time, or potentially here soon, where those won't be the drivers of returns. But for the recent time, it has been. And I mean, styles go in and out of favor, whether it's small cap does well or large cap growth does well. At any given time, your portfolio will behave differently than the broader market. And there's a number of different reasons for that. But we're confident that we're building a diversified portfolio that investors can stick with over time. That's what's important.
Yeah, thanks for that reminder, Greg. It can be boring, but diversification and behavior management are definitely the name of the game with a long-lasting, I would say, humble approach to investing. So thanks for that insight. So far we've talked about the why behind our portfolio. We've dove into, with Greg, the how behind our portfolio. Now we're going to tie things all back together, turn things back over to Matt to talk through investing for eternity. So Matt, how does a biblical worldview and view of biblical stewardship influence our approach to managing finances?
Yeah, it's that's such a good question, and there's different ways to approach it, and you could probably write a whole manuscript about the topic, and indeed many have. I would say, from the viewpoint of the Christian, and having that belief system, it's embracing a perspective that God owns and then we manage, right? Ron Blue, who's a champion in the space, says that there's only 5 uses of money, and he says you can save, you can live, you can give, you can invest, and you can pay down debt. So in light of the 5 decisions, that the 5 things we can do with money, it's to approach the challenges through the lens and perspective, and remembering that, hey, we're a manager or a steward instead of an owner. And I think that helps us kind of keep things in its rightful perspective, and maybe keeps us from getting too frustrated or too worked up over things that are out of our control.
Sure. So how would you say being a steward and having that eternal perspective, how does that give us confidence for our future with our finances?
Yeah, taking a real pragmatic approach to that question, it's thinking of our time on Earth as being very temporary, right? We're only here for X number of years. In the grander scheme of eternity, it's a really, really, really short amount of time. And I think of the picture that Randy Elkhorn has in his book called The Treasure Principle, and he's got this little dot on one end and then this arrow going to infinity on the other. And he makes the case that, hey, your money and what you buy and what you have is gonna perish when you die. It's not gonna last forever. But then what you give has this eternal impact. And so it's remembering that when we live for a future hope, then that helps us stay focused on what matters.
Thanks for that, Matt. So let's say I have a friend or a family member who would be interested in or benefit from this eternal perspective on financial planning and BRI, a firm that's partnered with Dave Ramsey. What would be a good way for me to introduce them to you, my advisor?
Yeah, well, we always would be glad to visit with your friends or family or be a resource for you. I can imagine that, the idea of your friend picking up the phone and calling a stranger, somebody they've never met before, and worst of all, a financial advisor, right? People envision calling a nerd who just wants to talk about graphs and charts and economic data, and that doesn't, that's a little intimidating, or it sounds really boring. Greg and I would love to talk about that for, hours. That's great, but most people don't want to. In any case, picking up a phone and calling in randomly is of course welcome, but sometimes people struggle with doing that. So what we find is that a really effective way to start that conversation, if you feel like there's a friend or a family member who could really benefit from what we offer, you can always shoot us an email and then CC that friend and say, hey, John Doe, meet Matt or Dylan or Joseph, and we'd love to start a conversation here because we feel that they could be a fit for you or what have you, and kind of starting off with an email is a really, really easy way to kind of make an introduction and is a little less stressful for that new person.
Yeah, awesome. Well, thanks for that. Awesome. Well, thank you, Matt, and thanks, Greg, for a lot of great insight and wisdom today. Thank you all for being here and for listening. We hope that this was really helpful, especially in light of the uncertainty with the election coming up, just knowing that we have a sound process to why we invest. We have a sound process on how we invest. And we really do try to tie that into how we are investing for eternity, those being the 3 points we covered today. I know we did cover a lot of content in a short amount of time, so if any of you do have any questions, please don't hesitate to shoot us over an email. A good email that we can receive questions at would be info@stewardship, INV, like the beginning of investment.com. So that is info@stewardship.inv.com. And like Matt said, a good way, if any of you do have any friends or family that would benefit from BRI and our approach to financial planning, we would love to be connected with them. A good way to do that would be via an email connection with all of us. And then if any of you out there are not clients and are also interested or would find it helpful to meet with a financial advisor, to maybe talk more through BRI, we would love to chat with you to be a resource. So we appreciate all of you and thank you for being here today. Hope you guys have a great rest of your week. Bye-bye.